early 20s. I had that big realization when I found out that the Federal Reserve was actually privately owned. And then I looked on the website in 93 when we just got the internet in Australia, and the Australian Reserve Bank had its charter online. And I read it, and to my absolute amazement, it said it's privately owned. Like, it meant all of that was true, that I just watched a 3-hour, videotape, VHS tape of I can't remember what that documentary was, but that was the one to watch. Way 10 years before Zeitgeist and all that sort of thing. Okay, so I'll go on about today's banking. We've got another 20 minutes, so should knock it over. Okay, so what happens today? So you've got a family, you're working and so on. You go to the bank to borrow money. You want to buy a house, okay? So the banker who writes a contract for you. Now what happens is when he approves this loan, he doesn't drive up with a big truck of money and dump a load of money on your lawn and say, well, there you go. Okay, what obviously happens is that he turns on his computer and you turn on your computer and basically says, okay, in Australia, for example, you need 10% deposit to borrow money, okay? So if you want to borrow, say, $950,000 to buy a house, I don't know how much, maybe it's a pretty big house, 3 bedrooms, say. So he says, right, give me $95,000, right? So you give him your $95,000. That's your proof that you can work and earn money, and this is how much money you save. So you're a good investment for him. So he puts that $95,000 in his computer, and then he transfers the $950,000 into your account. Now, what's actually happened is he hasn't transferred any money out of his account because he has the right to print that money 10 times over. So that $950,000 that you've given him, he's just multiplied that by 10, and that $950,000 has just actually appeared again from thin air and been put into your account. So the bank hasn't actually given you a penny from their money. Now this is where we start understanding about money as credit, or more correctly, money as debt. So we have real money and we have debt money. So real money is the money that you find in your pockets, the folding stuff, the dollar bills and so on. That's real money, we'll say, okay? So how much do you think makes up of the money supply? How much do you think accounts for the actual cash? Where you see those armoured cars driving through the city loaded up with money, those phenomenal piles of money that you see in the printing presses pumping out sheets of $100 bills. Take a guess of how much that accounts for the money supply? 7? Yep, I'm shooting for 5 for this one. So cash makes up about 5%. And the other 95% is debt, okay? So that's the money that's being created basically from borrowing, okay? So that's the money that when that guy borrowed the $950,000, that $950,000 was debt money, which appeared out of nowhere, and it goes into the money supply. So before he applied for that loan, that money didn't exist, and the bank created it. When I'm walking through London, when I went back to London last year, I'm walking through, I'm looking at these, anyone been to London? Yeah, walking along, looking at these incredible buildings and huge, like St. Peter's Cathedral and things like that. And they're all built in the 1800s and 1700s, 1800s. And I'm walking along and I'm looking at them just going, God, like England had so much money, like had so much wealth that they were able to create these amazing edifices. And, and now I wanted to get a picture of that, and I couldn't find it. But I got a photo of Melbourne, where I came from. And funnily enough, when I was looking at this photo, I realised that actual building in the middle, that's the bank. It's one of the buildings that the bank's built. Now, this is the Melbourne City, so we can use it. It's the same thing, but it's just newer. So I'm walking along, and I've often thought to myself, where does the money come from to create these buildings? Like I could borrow $1 million maybe, and I could build a 2-story house. But how much money would it cost to build like a 30-story building in the middle of the city? Like it just sort of blows my mind. Have you ever thought that same thing? Yep. Well, of course, when you understand where the money comes from, you realize that the bank creates that money out of nowhere. So say that $1 billion that was needed to build that building, they've conjured the money into existence using fractional reserve lending. So they would have had maybe a $1 million deposit, for argument's sake, or 10 million, but that was enough to create the rest of the money. Okay, so that's where the money comes from. It actually doesn't come from anywhere. It just gets created, and then it just goes into the money supply. And this will become clearer too as we go. So what happens if you're paying back the money back to the bank, and you're paying back the debt, and you're paying back the interest? What happens if you lose your job? Okay, so basically you're there, you go to the bank and you say, look, sorry, but I'm out of money and I've lost my job, and they shut down the factory where I was working and all sorts of stuff. Well, what's the bank going to do? You know, they're going to say, look, no worries, we understand there's tough times and things like this. We'll just wait for you to go back to work. Not on your life, okay? They're going to basically say, well, that's great because it says right here that because in the event of this, we foreclose on your house. And this is why in America, you've got actual families who are camping outside their houses, which they've just built, but they can't pay the money back. And vandals are in there tearing them apart and destroying them. And the banks are basically just kicked the people out, and now they're just selling them off for pennies. So your asset is sold. And so the irony is that they created that money out of nowhere, and then basically they take back your house, which is a real thing. It actually has value. Okay, so you've got your savings. What happens when you put your savings into the bank? Well, the same way, the bank can multiply your saving deposit. So if you've got $1,000 in the bank can create $10,000 in debt money and lend that money out to people. Okay, so not only do they multiply that by 10, but they also multiply the interest as well. So if they're charging, say, 10% interest on the money that they're lending out, they're actually getting 100% interest on the 10 amounts of money that's actually being lent. So when you actually give money to the bank, you're not actually giving it for them to protect and look after. You're actually loaning that money to them. If you read the details, it's actually a loan to the bank, your savings. Now, if the bank had never, if the bank actually was an institution that lent out people's savings and made money on the interest of people's savings, which is what we were told as children, and some of us, or most people still believe this to be true, then your bank balance would change from time to time, right? If I had $10,000 in my bank, I went in one day and I noticed now there's $8,000, and I said, where's the $2,000 gone? And the bank said, we lent it to Eglay to buy a car, but she'll pay it back in 12 months, and don't worry, we'll give you some of the interest. I'd go, oh, right. Oh, well, gee, how about that? But does your bank balance ever change? Of course, it never changes. So where is that money coming from that they're lending out? Agreed? Right. So that's fractional reserve lending. Okay, so now just talk about the government. Now, of course, when it comes to borrowing, there's nothing like government. Now, here you see what $1 trillion looks like. So they're all $100 bills. And I'm sure you've probably seen this already, what $1 trillion look like. It's a football field full of pallets of money stacked up about so high. So it's funny how we used to talk about billions, and now we just talk about trillions. I mean, 1 billion is 1,000 million, but 1 trillion is 1,000 billion. But we've just sort of changed the B to the T in our puerile and juvenile understanding of money. And we go along with it. Oh, the national debt is how many trillion now? So what does the government do with the money? The government does whatever it wants with the money. It just spends on things like spying on you, on drones, on vaccination programs, which is probably killing everybody. Anyway, and that's what it does. So where does the money come from? Okay, so you basically what happens is the government, it issues a bond, and it gives this bond to the bank, to the central bank. And of course that bond is really nothing more than an IOU. It's a promise to pay. And then what happens is the Federal Reserve will then basically give that money to government. But before the bank wants to lend the money out, what does a bank always do before it lends money? What does it need? Correct? Right? It wants a guarantee. It wants a guarantee from the government that it'll pay the money back. So what do you think the government does? What does it say? They're like, we've got these armoured plated cars that I drive around in, and my White House desk is an antique. It must be worth something. Right? Do they ever say that? Of course not. Right? Where there's a school, you could probably have that. It's full of children. Right? The government says, I have these things, and they're called taxpayers. Okay? So my taxpayers are my guarantee that the money will be returned. Because we have these people who enforce taxation, and these people who are our taxpayers pay tax. And the bank says, that's great, very good. If you've ever noticed when you have your birth certificate, that your birth certificate is called, you register, okay? So you're now registered with the king, the queen, the government. So registration, regis, means the ruler, okay? So you are now recognized by the ruler. And what actually happens, believe it or not, is your birth certificate is a guarantee to pay that the bank trades on. That's why government keeps records of your birth, marriage and death, because it's a record of assets that are going to pay money back. Right? So, and they actually, believe it or not, they trade on this. I can't tell you, you probably know the details. I've only vaguely heard the details, but they do trade on people's birth certificates. And also your marriage. Like when you get married, they register that, because what happens when two people get married? They are most likely going to have a baby. So that baby is an asset to the state to basically use for tax-paying purposes. So the government spends the money, and you, the taxpayer, you pay it all back. So what happens with your tax money? Your tax money goes back into government, and the government, of course, it takes the money and it pays it back to the bank. So about 70%, I think, of the national debt is basically money owed to the bank. So it's not going on schools and hospitals and things like that it should be. It's basically just going back to pay back the debt to the money to the bank, plus the interest. But what about the interest? The money, what happens and where does the money go, or where does the money come from to pay for the interest? Because when money is created, the money to pay for the interest is never created at the same time, because it's a percentage of the actual money. So here's the situation. This is another key point. If I borrow $100, and that's the only $100 in existence, and then basically there's the interest of $1 on that $100, when I pay that $100 back, the bank is going to ask, where's the dollar? Okay, because that's the interest. So I don't have a dollar because I've just given you back $100. There is no dollar. So the only way I can pay that dollar is by borrowing another dollar back from you so I can give it back to you. And of course that dollar will have interest of maybe 1 cent. So then I'll have to borrow a cent. You know, see what I mean? So basically you can only keep borrowing. There's no way to pay back the interest because the money doesn't exist. So what happens is there's always more money in debt than there is in actual supply. Okay, and we'll examine this a little bit more as we go. So how does the government pay the interest? Okay, all the government does to pay interest is it just keeps borrowing more and more money. So of course the more money it borrows, the more interest basically just keeps growing and growing and growing. So if you had a friend who was in debt and your friend says, I'm owing all this money to the bank and I'm using my credit card to pay the interest on the money that I owe. I can't even pay back the money. I can only pay the interest. It's so much money that I'm in debt to. You would look at that like people are shaking their heads. and you'd think that guy is in a really bad way. Okay, we'd feel sorry for that bloke because he really is hard up against it. So that is basically what the government is doing. It's borrowing money just to pay back the interest. And that's why entire countries, huge economies like America and Europe, are in debt. They're deeply in debt. Okay, now every country is in debt. Every country has this money that it has to pay back to the banks. Now, the national debt of Australia is $535 billion. That's roughly 22,000 per capita. Man, woman and child owes money that has to be paid back through their taxes. The UK, $1.5 trillion, which roughly equates to twice the debt of Australia. So that's $50,000 per head, man, woman and child, right? Yep. And of course, the US of A is $18 trillion in debt, and $18 trillion debt is roughly the same as the UK, 56,000 per head, man, woman and child. Okay, so each household probably owes around about $150 to $200 to maybe $250,000 is debt that will be paid by them back to the banks. Okay, now imagine if I had a daughter and basically I gave her a platinum card, and as parents, basically we said to her, you can just use the card, we'll pay the bill. Okay, so whatever she uses that card for, she goes and buys a new computer, she goes and buys, eventually the borrowing gets bigger and bigger. Cars, things like that, holidays, trips, things like that. And of course every month the statement arrives and we just send the money to the bank. We pay for it, right? So she's never going to pay the money back. She has no intention of paying the money back because we are paying the money. Okay? Now unfortunately government is like this. The problem now is that government has no intention of paying this money back. And the people who are having to pay the money back is us, because we pay this through our taxes. But the government is spending basically whatever it wants. It's not acting in a responsible way. So, as a result, what happens is we end up with a huge national debt, which future generations who haven't even been born are going to be paying this money back, because by borrowing and creating more money, they're pushing the debt further and further into the future. Babies who are coming into this world are already saddled with this massive debt, $56,000 US, in the moment they've arrived. So why do we have debt? So what happens is Mr. and Mrs. Joe Average, you folk, right? We pay our debts back. We pay our taxes. We're responsible citizens. So that money flows back into the banks, and that starts to extinguish the debt. And what happens is people borrow money, and by borrowing money, that allows money to flow back into the money supply, and this is how it works. But because of the interest, that debt money will just keep very gradually growing and growing and growing. But that's how we keep the money flowing, is by paying the money back, extinguishing the debt, and then people borrowing money back goes back into the money supply. Of course, as we see, the debt will continue to increase because the money to pay back the debt is never created, okay, because it's a percentage. It doesn't exist. So here is a strategy. Why does the debt slowly increase? Have you seen the frog in the pan? Okay, you may have heard the story that if you want to cook a frog and you've got boiling water and you throw the frog into the boiling water, what's going to happen? Andy? It'll jump out, right? It'll realize that the pan is hot and it'll jump away. So if you want to cook that frog, you put it in cold water and then you gradually warm the water up over time until the frog basically is sitting there relaxing in the hot tub whilst its friend has already died. So it's about cooking the frog. What's the term we use? I can't remember the exact word for it. The frog in the pot, or boiling the frog. Yeah. So it has to be done gradually, gradually, gradually. The economy gets heated up. It's because we being the frogs, if all of a sudden we had this massive debt, we just rush into the streets like the French Revolution and we want to guillotine everybody and, because we're outraged. But if it happens very slowly and gradually, we're quite happy to just sit there and just keep accepting the burden more and more and more over time. So that's one of the strategies. And so what happens is when the debt monster gets so big, the government runs to its advisors and it asks for advice. And of course the advisor's always the same: borrow more money. Okay, that's the only thing you can do, is keep borrowing. So it goes, great, I've just been to the summit and I've had a chat with our financial Greenspan Alan, whatever his Shaftesbury, whatever his name is, and he's given us this great advice that we need to now use what's called quantitative easing. So everyone relax, because now quantitative easing is going to relieve our burden. And everyone goes, great, quantitative easing. And what is quantitative easing, by the way? You don't want to know about that. Of course, we do know that quantitative easing means we're turning the money machines on, and we're just printing ourselves out of debt, okay? And creating, like the Arab Spring was a result of QE1. Because the US dollar was worth nothing, and it's used to pay for oil. So when all the guys in Egypt and so on realized that they couldn't buy the basic commodities because the US dollar value had gone down because they were printing so much money, it caused the cascading of the uprisings that went throughout Syria and Libya and all these other places. Anyway, so what we have is a cycle where the cycle of inflation drives up prices, then we have an economic slowdown, and when the economy starts to slow down, people stop borrowing money because they're worried, and when they stop borrowing money, there is a contraction of the money supply. So why is there a contraction of the money supply? Because people don't want to borrow money because they're frightened. They want to hang on to it. But what happens is people keep making their repayments, okay? So they won't borrow money, but they keep paying back the money that they owe. So because they're paying back the money, the debt is being extinguished, but at the same time, the money supply is reducing. So what happens is you have deflation. And when the money supply starts to dry up, it becomes pretty desperate. And what happens is the banks, to try and keep money flowing into the economy, they start to lower and lower their interest rates. As I found out the other night, the interest rates have been at 2% since 2008 to keep money flowing into the economy, because if people stop borrowing the money, money's not being created, and therefore the money supply dries up. And what happens is now you've got banks in Germany offering negative interest on money, right? So if you borrow money, you'll actually be making money. They're that desperate to try and get you to borrow money. And the reason why is because when you reach a critical point, the whole economy goes into recession. Now, of course, as we know with recession, that empires collapse not from inflation, they collapse from deflation. That's when the whole thing comes down, when the money runs out. So what you've got is you've got these PhDs, these experts, economists, financial theorists, fiscal policy makers, quantitative easing lazarios, and basically all they're doing is a surgery on the frog. They're being critical decisions to stop that frog from boiling in the pot and keeping him basically there to stop this economy from crashing. But what happens is it's inevitable. It will eventually collapse under its own weight. So what's happening with the bank is they're doing a very delicate high wire act between the money supply and the debt, and the consequences of coming off the wire is there's an economic standstill, total financial chaos, social disintegration, lawlessness, starvation, war. These are the potential consequences of the economic collapse. So these are these guys taking these risks. So imagine if you went to your travel agent and you said, look, I've got this destination I'd like to get to. Can you help me get there? And what do we need to do? He says, that's great. I've got this thing. It's called the debt cannon. And I'm going to punch you into this cannon and I'll fire you out towards your destination. And you sort of sit there and you go, sounds a bit risky. What about if we had another way. He said, yep, that's fine too. You could swim and you'll be sharing the water with the boom and bust economy, so there's potential of complete social disintegration whilst you're making your way to your destination. And so you, as the average taxpayer, as the average consumer, you're going to ask yourself, you know what, that sounds a little bit risky to me. That sounds dangerous. Is there some other way that we could still achieve our goals but not have these horrible consequences, catastrophes? So just for argument's sake, what if we didn't have interest on our money? Well, we'd still have the same thing. We'd still be paying our taxes to government. Government would still be spending money and spending money back into circulation, into the economy, by building bridges, roads, hospitals, paying people's salary in the military and within government. And we'd also have money to pay back the debts, so the money that we've borrowed from the bank. And of course, there'd still be people borrowing money, and money would still be flowing into the economy. But there won't be the inflation. What we do is we just basically decide how much money do we need. And that is the amount of money that we keep in circulation. And it's like an equilibrium. That's one possibility. Agreed? What the banks have is this thing called the business cycle, where you have basically economy goes up, inflates, and then basically it stalls, goes down, you have a trough and recession, and then it basically just goes up and down, up and down. So they call it the business cycle, which is described as a natural consequence of an economy. Now, of course, this natural business cycle, it's complete bullshit, because the problem is that they do this inflation and deflation is actually created by the banks to absorb wealth and then distribute debt again. But that's another part of the story. So just to explain about money supply, and I think we'll have a break after this. Now, if there was a pub, okay, and everyone's having a great big party at the pub and so on, and I'm there, and I go along, and then as we're basically, every time I go and buy a drink, I take my drink, I finish it, and I go outside and I put the glass in the boot of my car, okay? And as I'm walking around the pub, I'm picking up glasses, but I'm instead of bringing them back to the bar, I'm taking them out to the car. And I've got a little Balinese guy there who's washing the glasses and putting them back into a cardboard box. What's going to happen over time to the pub and to the party? It's going to start to slow down, right? Because they're going to realize we don't have enough glasses and the glasses are starting to disappear. Now, eventually, the publican won't be able to pour any more drinks because all the glasses have gone. So by simply taking these glasses out of supply, I've collapsed his economy and I've brought his whole thing to a standstill. Now, do I care? I've got a carload of glasses now, right? So I've got all the glasses. I can do what I want. I could come back in maybe in the morning and say to him, hey, I've got a lot of glasses that I wouldn't mind selling to you. You want to rent them off me? Or I might, in the middle of his crisis, I might come to the bar and just say, I heard you ran out of glasses. I've just brought you a carload. Give me £300 or give me $1,000 and you can rent them for 24 hours. I mean, what's he going to say? You see? So by controlling the supply is how you control economies. And the people who lend money, the question is always about supply, because the supply makes the difference. And of course, this is the elephant in the room. It's actually the money supply. Okay, so let's stop there and let's have a break. Okay? Thanks. We'll have a 10-minute break and then we'll fire up again.